In my previous lecture, I have discussed about concepts and construct. In research, concepts are conceptualized by giving them conceptual definition. After that, they are operationalized by giving them operational definition. Operational definition means how we measure any concept. For example, text is a concrete concept and text is conceptualized by giving conceptual definition. Conceptual definition depends upon your research topic and in what context concepts are used in your research. Then operational definition depends on conceptual definition. If you are using sale text as a conceptual definition, then operational definition would be tax on sale of goods or services by sellers. And if you are using income tax as a conceptual definition, then operational definition would be tax on income of individuals. And if you are using corporate tax as a conceptual definition, then tax on profit of companies are the operational definition of corporate tax. And if you are using property tax as a conceptual definition, then operational definition would be tax on property or of individuals. Similarly, service. Conceptual definition is courier service. If you are using courier service as a conceptual definition, then operational definition of courier service can be defined in terms of dimensions and indicators, which can be delivery services, customer services, accountability and reliability, delivery cost. At empirical level, the concepts become variable. A variable is any concept that can assume different numerical values. A variable can be any event, any characteristics, any attributes, any trait, any act. Type of variables. A variable can be categorical, for example gender, which has two categories such as male and female. A variable can be discrete, for example age, family size. And a variable can be continuous, for example income and prices. In research, we use different variables as dependent variables, independent variables, controlled variables, which can be motivating variables, conditional variables, and intervening variables. Dependent variable is the one which depends on any other variable. The variable which is affected by other variables or which is explained by any other variable is known as dependent variable. In x and y relationship, x affects y. In this case, y is an independent variable. Independent variable is the one on which dependent variable depends, and the variable which affects dependent variable or the variable which explains dependent variable is known as independent variable. In x and y relationship, x affects y, and here x is the independent variable. For example, consumption expenditure of families increases with their monthly income. Here, consumption expenditures is dependent variable and dependent variable is income, and income affects consumption expenditures. Control of variables. A control variable is a variable taken into account when exploring the relationship between an independent variable and a dependent variable, and the goal is to control for the effects of other variables. Control variables can be moderating variables, conditional variables, intervening variables, or moderating variables. Moderating variables, conditional variables. Moderating variables or conditional variables are those variables that have contingent effect on original relationship between dependent variable and dependent variable. A variable that accounts for a change in the relationship between an independent and dependent variable when general conditions change is known as conditional or moderating variables. For example, in x and y relationship, a change in x causes a change in y for a given change in m. Here, m is the moderating or conditional variable. And here we refer the effects of x on y for a given value of m as the simple effect x on y. For example, consumption expenditures of families having monthly income level rupees 10,000 increases with their monthly income. Here, dependent variable is consumption expenditure, independent variable is income, and conditional variable is income level rupees 10,000. So, income of families having income level rupees 10,000 affects consumption expenditures. In another example, household savings increases with their income among urban population. Here, a dependent variable is household savings, independent variable is income, and moderating variable is urban population. So, income of household among urban population affects household savings. Intervening variable or moderating variable. An intervening variable links an independent variable to a dependent variable. In x and y relationship, a change in x causes a change in I, which in turn causes a change in y. Here, I is the intervening or moderating variable. For example, advertising expenses increase profits through increase in sale. Here, dependent variable is profit, intervening variable or moderating variable is sale, and independent variable is advertising expenses. Here, advertising expenses affects sales, which in turn affects profit.